Okay, so we discussed about the conservative mutual funds, which are you have your money market one, the bond fund, the preferred share ones, which is the dividend fund, right? Um, and they are less risky. They are the ones which are more conservative, right? And the mortgage fund also. Four of those are in your conservative ones. And then the riskier ones that we talked about, the equity fund, which is in stocks only, the balanced one has stocks and bonds, and then you have the global fund, which is international all over the world, and then international ones also are in there in the global ones, and then you have specialty ones, example, which are only type of in one type of investment, right? So that was chapter number 12. Now I'm going to skip over to chapter number 14. We'll come back to chapter 13 later. So the next one we're talking about is your chapter number 14. So I'm going to come back to the slides now. Okay, so let me bring up the slides and we're going to continue our discussion over there. So let me share screen. Yes. So you guys can see my screen, right? So the purpose of, in your slides also you have this information, so you can go through that, but I showed you on Scotiabank website about these, right? I think we did not talk about the target date one. So the target date funds is the only one which we did not talk about, which is in your notes also. Target date funds are usually used for the, okay, sorry, it's not stopping, stop. Okay, there we go. So the target date funds are the ones which are invested for a certain time period. They're usually used for the example of RESP, Education Savings Plan, or somebody has for example, retirement savings plan, registered RSP, and in the RSP, they want to invest it for a certain time period, right? So sorry, let me go back to here. The target funds, that is the only one that I think we did not, yeah, here, this one. So target date funds, they were introduced in 2005. They have two features. They have a glide path and a maturity date. Glide path, what it does is, I'll show you an example next later on. Remind me, I'll show you the target date fund. But what we're saying here is that initially it has a investment mainly in equities. First, it's going to be risky. Let's suppose it's a 10-year fund. Okay, let's suppose you plan on retiring in 2031 after 10 years. So initially, first couple of years, the mutual fund in the target date fund will have more equities and shares and less bonds. And as the years go by, the portfolio manager will sell the equities and buy more bonds. So as you reach your retirement age, it will become less risky. So this is a target date fund. The portfolio manager changes. This is called the glide path. That is, over time, the asset allocation within it. Asset allocation is that pie we looked at, the distribution of the money in the fund, that will change over time. And it will reduce the risk of the fund as you approach the target date. Is that clear? Is that okay?
So when it's about to mature, the risk factor will reduce?
Yes, it'll be reduced. Yes, that's right. Yes, exactly. Right? So the risk will be reduced when it reaches near the target date.
And that is because it's getting closer to its target, like the date that it's supposed to end?
Yes, that's right. Yes, exactly. So anybody has a child who's going to go to college in 15 years, initially it'll be more riskier. Then as it reaches nearby that time, it will become, the composition will be changing slowly, and finally it will reach to that. At that time, it'll be less risky as they near going to college, right? Yes. Okay. Good. All right. So yeah, I think we should talk about here in the equity funds market capitalization. This I mentioned to you, so you should remember, very important point. Market cap is equal to number of shares outstanding. That is, so how many people bought the shares? Okay, if there's Royal Bank shares, there probably will be hundreds of people, thousands of people have bought it. More people buy it, then they will, then their market cap will go up, right? And the market price, if the market price goes up, the market cap will also go up. So if there's 10,000 shares people have bought and the price is $10, so what is the market cap? Yes, anybody? What is 10,000 times 10?
100K.
100,000, yes. 100,000 will be the market cap. Now, if more people buy the shares, if 20,000 people buy the shares and the price is still $10, now what is the market cap? 20,000 people buy the shares and the price is 10. So 20,000 times 10?
20,000 times 200.
Yes, 200,000, yes. Right?
So
Grade 4
market
math.
capitalization. So if we get a question saying what's the market capitalization or something, it just amount of shares times it by the price.
Yes, that's right.
Okay.
Okay. And see, okay, if there was 10,000 shares and the price went up to $15 instead of 10, now what is the market cap going to be?
150.
150,000. So as you can see, if the share price goes up or the number of shares people buy goes up, the market cap will go up.
Mm-hmm.
Right? Okay. Clear? Good.
Yep.
All right. So that keep in mind also. So we talked about these already. Cash equivalent, fund wrap. Fund wrap is similarly like, portfolio investment. We talked about this global ones also. You can read through the slides there. I'm not going to go through those again. Okay, so now we jump to chapter 14, understanding the performance of mutual funds, right? So in the performance of the mutual funds, we are going to, so fund, usually the fund, sorry, we compare the fund to the average. So how do we measure the performance, right? So compare the fund to the average, or you can quantify against a standard like the T-bill rate. So if this is a money market fund, you can compare it to the T-bill return, right? So you have to compare apples to apple. The main thing with the portfolio performance, portfolio means a mixture of different investments. When you have a mixture of different investments, you want to compare apples to apples, right? And that way you can measure what is the growth. Now, how do you measure the growth, the percentage gain? So ending NAVPS minus beginning NAVPS divided by the beginning NAVPS. What do you mean there? If it was $12 and it was $10 before, we divided by, what do we divide it by? 10 and multiply by 100. So if you want to do that in a calculator, so what is 12 minus 10? Grade 2 math.
2.
2 divided by 10. 10 is our beginning NAVPS. $10 times 100. So what do you get? 20%. So the gain is 20%. If it is now 12 and it was 10 before, you have a 20% gain or return or profit. So that is simply how you will do any calculation for any performance. Ending value minus the beginning value divided by the beginning. Again, this is, if you think of it, it's really yield. Return on investment. What is your return? You got $2 growth on investment of $10. So that is 20% gain, right? Same as the return on investment I calculation gave you before. So we'll talk about the Sharpe ratio later, but if you have two different returns with different risks, then we use a Sharpe ratio. And what is Sharpe ratio? That is, do I have the example here? No, we don't have example. Okay, it's in the book. A return of portfolio minus the risk-free rate divided by standard deviation. It's a formula where you just need to basically remember the three things they will give you in the question. The return of the portfolio is 3%. The risk-free rate is 1%. The standard deviation is 0.5. So you have to just take this minus that divided by the standard deviation and you get the Sharpe ratio. So just those three things you need to remember for the Sharpe ratio. And the Sharpe ratio purpose is it tells you the risk. Higher the Sharpe ratio, the more risky the mutual fund is. That's the purpose of the Sharpe ratio. Okay, clear? So we'll do the calculations later on. Um, for performance, so your question about the benchmark, we compare the performance either with a benchmark, a relevant benchmark, that is one way to calculate it, or the other way to estimate is comparison universe, comparison of a group of funds that have comparable asset classes and risk profiles. So comparison universe means you compare with similar. Let's suppose you want to look at the performance of a student in a school. If you compare the student in the school with their own classmates, that is, you're comparing, like they have had the same teachers, they have the same facilities and everything. That is like a comparison universe, right? In that class, some people will do really good, some are going to do average, some are going to do poor. So that's a comparison universe. The benchmark is you look at all of the schools in all of Ontario, what are their results? Okay, or what is the result for all of Canada for that grade, for that subject? That is a benchmark index. You're looking at the whole everybody, right? So in the benchmark, there's a lot of different mutual funds that returns that we're going to look at. Overall, the market return. Whereas comparison universe is more looking at similar mutual funds. That is where we look at comparison universe. So let's look at indexes. So index, your question about what are index. So we have different indexes. There is S&P index, which is Toronto Stock Exchange. So if Toronto Stock Exchange market goes up or down, if it goes down, it means most of the stocks in the index have gone down. So your index is going to indicate overall what is the economy like. As you know, like last year due to Corona, companies have suffered financially and the stock market has gone down, their share prices have gone down. So it's an indication about overall economy. So that is an index. Then we have S&P TSX 60. This is 60 largest companies on the stock exchange in Toronto. In this one, you have a lot, I don't remember, I think it's 1,500 roughly companies are listed on the TSX. Here you have only the 60 largest companies. That is another benchmark. Okay, if your portfolio has big companies, you should compare it with the S&P 60. You should not compare it with the S&P composite index, right? So it depends on what is your mutual fund composition. Then there's S&P 500, which is US companies, 500 large US companies. And there again, if you have invested in US mutual fund, you want to compare the returns with the market through the S&P 500. Then there's Morgan Stanley Capital Index of European. Obviously, this is if you are invested in that European mutual fund, you want to compare it with this index. Then, of course, there's Australian, there's Far Eastern, there's DEX also, which is so this is the bond index. This is the type of bond index which shows how do bonds go up or down. And then there's another one, Scotia Capital Markets 91 T-bill index. So you have to select the right benchmark, or it will be given in the mutual fund which one they're comparing the returns with. Clear? So performance assessment, we said already, we mentioned two ways you can do it. One is comparison universe, other is benchmark index, right? So it should be similar companies or similar benchmarks. You should not be looking at those which are different. So let's look at comparison universe a little more. So it's a collection of portfolios that form the basis of comparison. So there's a lot of risk. Like you're not going to be comparing 100% the same performance with the same mandate or same objectives. Remember, each mutual fund. So we looked at only a few of the mutual funds of Scotiabank. If you look, there's a long list of mutual funds for Scotiabank, and every company. There's a long, at least I think 100, at least each company has at least. And so there's going to be a lot of risk, also unpredictability, different standard deviations, different risk. Um, and some mutual funds may have done good, some may have done bad over the year or the quarter. So there's a lot of risk. You may not be comparing apples to apples. So that is the risk there with comparison universe. what is quartile ranging? Quartile ranking is what you do is, for example, if you have 100 mutual funds, you rank them top to bottom. Which one made the best returns? Then which one made, so top to bottom, and then you split it into four sections. The top top 25% is going to be the first part. Then the top 24 to 50%, that is the next one, and then 50 to 75, and then the lowest 75%. So you split up the mutual funds into four sections, that group, and there, so that's a measurement. Sometimes it's mentioned this mutual fund is in the first quartile or second quartile or third quartile. From there you get an idea, how does it compare to other mutual funds in the universe. But the main thing is you have to compare orange to orange. You don't want to compare a bond fund with an equity fund, and you don't want to compare like different types of funds with different types. So it depends, right? So this is the quartile ranking. Is that clear? Any questions so far? So in here, measurement should be immune to manipulation. Like it shouldn't be, some people they fudge the numbers. You don't want them to fudge the numbers for the returns, and it should only be measured based on what is superior, ordinary, what is lower. Should be realistic, and also, so this is survivor bias is a big trouble in this one. You see so if you find out this mutual fund is in the lowest quarter, it's in the fourth quartile, are you going to invest in it?
Pardon?
If you find if you find a mutual fund which is in the fourth quartile, will you invest in it? You're not going to invest in it, right?
No.
So now you're not going to invest in it, and other people are not going to invest in it. So those which are low ranking, their value, their investments are going to be going down and down. Their number of people invested in it are not going to be investing. People are going to pull their money out. They're going to sell their money from that low, ranking one, and so it will lose more money because people are going to pull their money from it because it's in the fourth quartile. So, and then you are going to be left with only the good ones. So survivorship bias says that all the performance reporting is good, but if you know which one is bad, you're not going to invest in it, and people will not invest in it, and then it's going to be going down anyways because people will pull their money from it. So that is the negative thing about it, right? All right, so that was it for chapter 14. Any question on this?
So what is actually survivorship bias? So like within that whole situation, what does it do?
So survivorship bias says that bias means preference, or means like, you're giving special preference to it, right?
Okay.
So the survivorship bias means that only the good ones are going to be left over because people will not invest in the ones which are in the fourth quartile, and they will pull their money from it. So that's a negative thing also. So that has that distorts the returns a little bit. So that's the negative thing about it. Okay, clear? Okay, so now let's go on to chapter 15. So as you see, these are like easy to understand, and we talked about this already when we looked at the fund facts. How does volatility impact the mutual fund returns? So we have got market. So we have mortgage funds, bond funds, real estate funds, specialty funds, and new information. If you get a new information about a company and they're invested in mortgages, and they're like, suppose people stop paying their mortgages, that has an effect on the price, right? So there may be some which are less volatile, some are more volatile. Volatility means the price of these shares in the company, in the investment, may go up and down significantly due to news. So the unique risk can be diversified away while market risk will remain. So we'll talk about different types of risk in this chapter. The risk Unique risk is that which you can modify. You see, if you have four stocks in your investment, that will be risky, right? If you have 50 stocks, that will be less risky, right? So you're reducing the unique risk by diversification. You can do that, right? Is that clear?
If it's what?
If you diversify, if you add more stocks to your portfolio,
Mm-hmm.
then you will have a so unique risk means if you have more diversification, you will have less risk, right? You're reducing the risk because you added more stocks to your portfolio. But there's a limit. Let's suppose you put in 100 stocks,
Yeah,
right?
that is true. So just in case one stock goes down, at least the other one could make probably go up.
Yes. But if you put in 100 stocks, 100 shares, different companies in your portfolio,
Mm-hmm.
your risk will not become zero, right? Your risk will still be there. It will still go up and down with the market, right? Market risk will always remain. So what we're saying is that if you have one or two or three investment stocks in your portfolio, that's very risky. And if you have 10, 20, 30, your unique risk is reduced. But if you have 100, 200, 500, your market risk will always be there. You cannot um, you cannot finish that market risk. Okay, so we'll talk about risk a little more in the next slides, but that's the concept there. So there are, as you can see, like 5,000 different types of funds, and there are 45 categories of funds. So there's a Canadian Investment Fund Standard Committee, that's their job. Like they categorize all the funds and everything, right? So um, it depends on different things they look at. They look at overall the people, like portfolio managers, and yeah. So usually manager, it's managed by a portfolio manager with several years experience, backed by a team of analysts and technology. So portfolio managers, what they try to do is they try to increase the amount of investments. Remember, we saw like the money market has maybe $100 million in it, and the equity fund had like $2,700 million. So assets under management is a good sign. The more people, if you look at all the mutual funds in a company, usually the one where there has more investments amount under assets under management is a good sign. It means a lot of people are investing in it, and big companies are investing in it, so it's a good investment, right? So that is one indication about like what, so we're talking about here is the title, what are the elements to consider when analyzing and selecting mutual funds. So number one is people, the portfolio. If you have the portfolio manager, they have a lot of good experience. So we saw there the different portfolio managers, they have different experience. The team is really, highly qualified. They have a good track record, and you have a lot of assets under management. It means that it's a good investment. So that's one thing to look at. Second is the philosophy. So the philosophy is what is their objective, like equity investing. Some of them do value investing. If you go to a thrift shop, sometimes you get some really good deals. You can get brand name items for really cheap, right? So if you're some of the investors, the portfolio manager, they seek bargains. They're looking for bargains. They're looking for shares which are good companies and their share price has gone down. So they try to invest in those because they think that over 5 years, 3, 4, 5 years, they will go up, right? So they are looking for that type of investment, and they are looking for growth investing. They're seeking in sectors of expanding earnings. Others are, so there's one, so there's a different philosophy. One is value investing, others growth investing. They're only looking at those sectors which are expanding earnings, like for example, financial sector. No matter what, stocks for banks in Canada have gone up, although last year, of course, they did go down, but they usually are going up. Sector rotator, that's the manager's attempt to profit through timing, and more emphasis placed on industry weighting. So the one is value investing, second is growth investing, third is sector rotation. Sector rotation is the manager is going to keep moving the money within different sectors. For example, first they invest in the in food companies, then they invest in the mining companies, then they invest in financials. So they move around their money into different sectors, into different industries. That is another philosophy. And then there's momentum investing. Managers believe that strong gains in earnings or stock prices will result in stronger gains in earnings or stock price, and they're more concentrated in certain areas of the economy. So that is the other one. So you have to see what is the philosophy of the portfolio manager. Are they doing value? Are they doing growth? Are they doing momentum? Are they doing sector rotation? Um, uh, and that could be something to consider when you're selecting a mutual fund. Okay. The other thing to do is you should look at overall um, processes by which values accrue to the fund. So there's things which you can see overall. For example, records of company visits. Did the portfolio manager go and visit the companies they're investing in? Did they do manager interviews? Did they do what is their screening and selection criteria? How do they decide which type of mutual fund or which type of stocks to invest in? Do they analyze the economy? Do they analyze the sectors? So these are things to look at. What is their process in with for that mutual fund? How they decide on investments. Then other things you look at, of course, you want to look at performance. You don't look at just those things. You want to see the performance for that mutual fund, right? What is the overall? Is it 20% um, simple return or 20% over a time period? Is it compound return, right? So what are the steps you should take? So research the performance data, look at the performance data, look at the investment objectives for the fund, look at long-term performance. You should be putting it in for 3 year or 5 year. You want to look at long-term returns. Don't just look at how much did it make in 3 months or 6 months. Focus on best year-to-year performance. Look at the return, which one made the best return year over year. Focus on good performance and low volatility. So those which are doing good returns, even if the market went down, they did not go down a lot. Those are good performance. Look at the investment managers in it. Who are the portfolio managers? Do a little research on them. What is their track record? Compare the fund facts. So look at the fund facts for 2 3 different companies. Usually when you're dealing with clients, you don't want to give them 20 different mutual funds. Here, select one. No, people usually don't know. You usually will give them one, two, three usually options. Okay, it's good for you to invest in equity fund. Here's 3 types of equity funds. Discuss with them and let them decide and give them your advice also. Then examine fees. Look at the fees for the mutual funds. What are the fees for them? Examine the fees. Look at how much is invested in the fund. So the ones with like more money in them, usually they are the ones which people are very confident in, and they are also a good idea. And then make your decision, right? So all these things we should look at. Like, so don't just like we mentioned, don't just look at the fees. Don't just look at the MER. Oh, this is a cheaper one. The MER for this is cheaper. I'm going to go for that one. That's not a good way. You have to look at all these things when you're deciding on which mutual fund to invest in.
Sorry, what's style drifting?
Which one? Sorry.
The style drifting, like analyst, the style analyst, and the study of style drift. What does that mean? Up here, sorry.
Oh, style drift. This one here.
Yes. What is that?
Okay, style drift is so where they are, their investment manager's style may change time over time. So if they are first values, these one we're talking about here, if they are first doing value investing and then they go to growth investing and then they start doing sector rotation and then they go back to growth, so that's like style drifting. So are they consistent in their philosophy or they keep changing their style? Okay, right. So that's something to look at. Clear? Okay, so these things, so those we just mentioned, a little more detail about those steps we just mentioned. So research the, so when we're talking about objectives, you're looking at two equity funds or two real estate funds. Don't compare money market to a real estate fund. Focus on long-term performance. Like I said, look at 3 years return usually is a good idea. Focus on best year-to-year performance. Focus on good performance with low volatility. So you want a low, so the reward to risk, so obviously we saw there those ones with high returns have a high risk also, right? The ones with which, so the equity funds, you can make a lot of money but you can lose a lot of money. Same thing with the, um, we saw the resource fund, it went up a lot, it went down a lot, right? So how much risk are you willing to take for the return? This is the risk return, reward to risk ratio we're looking at. So the fund return or the standard deviation is important. Standard deviation gives us an idea of the risk. Um, if we have a standard deviation of zero point 0.5, this means that um, the fund earns 0.5% for every 1% of standard deviation, right? So if another fund is zero point 0.6, it means the fund can earn a better return for the 1% of standard deviation. So what we're saying here is that you need to look at overall the standard deviation. Okay, so again, we're going to spend next, I think, session or maybe the one after that on the calculations. So don't worry about the calculations here. I want you to just understand that when we're deciding on the analysis, which one to select the mutual fund, you need to look at what is the risk. Higher the standard deviation, the more the risk. If you're willing to take on the risk, then you can get rewarded more. If not, then it'll be lower. Okay, so we'll do the calculations later on. We want to look at the top performing, of course, investment performers, investment managers. We want to compare the fund facts. We want to look at the fees. Like we said, performance data reflects management fees and operating expenses charged to the fund, but it may not include other fund fees. So we will talk about the fees in the next chapter. There are load fund fees also. When you buy and when you sell a mutual fund, you may need to pay a fee. So these fees are not bad when an investor holds funds for a long time. Like if it's a 5% charge over 10 years, then it's not a big deal. But generally, some investments they have a lower MER. So it depends. Like you have to see, are you willing to pay a higher MER in order to get more return? So you have to look at the fees. And the size of the fund we said is also important. Assets under management, AUM, you want to see how much is invested in it and then make the decision accordingly. So that's it for chapter 15, right? So next we're going to talk about mutual fund fees. So we'll start out on this. We have 15 minutes more. I think we can finish that also today. So is my speed okay? Is it everything is okay? Hopefully you guys are following along. I'm not going too fast, am I? Is the tempo okay?
I forgot. Yeah. So
That's
far,
okay.
like everything's good. Like I'm definitely gonna reread all these slides.
Yes, like tomorrow we have day off, so that's why there's a break in between. Then we have 2 days, and we have Friday and Saturday. Okay, then Sunday's off, and then we have Monday and Tuesday,
Yeah.
right? And we are going to spend a day like almost on all the calculations. I'm going to give you some worksheets, and we will do the calculations together. There'll be some examples. We will go through all those. Yes. So yeah, I think so we can spend the time wisely. Yeah, and we can do some questions also at the end. I will go through some questions, basic attempting questions also. Okay, so mutual fund fees and services. Now we talk about the MERs and the sales charges. So like I said, two main types of fees. Nothing is free, and when you're buying the mutual fund, you're going to pay management fees, which are payable by the fund to the fund service provider, and they range from 0.5 to 3%. So the management fees are always going to be there. And the sales charges, some funds they have a sales charge, others don't. Okay, so the sales charge may be there or may not be there. So we will, okay, let me see here. We have the calculation here, 10% fee, MER, trading expense ratio. Okay, so yes, okay. So two things we need to calculate. One is the fund offering and the purchase price. Okay, so the funds offering or purchase price when it has a front end load. So front end load meaning when you buy the fund, you have to pay a charge, you have to pay a fee. Okay, so first of all, you have to see what is the NAVPS, and then you make an adjustment for the load charge. Let's assume you have a NAVPS or price per share of $12. So one share or unit is charged is $12 and the load is 4%. So what are you going to do? You're going to do 100% minus the 4%. So 100% minus 4%, you will get 0.96, right? And that will be the calculation you're going to be doing is you're going to do 12 and 12 divided by 0.96. So that will give you 12.5. So we'll do the calculation again later, but the sales charge is mainly saying if you buy the mutual fund, you are going to pay an upfront cost, and that will make it more expensive for you when you buy, right? And instead of paying $12, you will pay $12.50. So this is the concept of the sales charge. This is called the front end sales charge. The other fees you may have to pay is also the trailer fees. Trailer fees is if you buy your mutual fund through an investment company with an investment advisor, the mutual fund investors must pay an annual fee based on the fixed percentage of assets from 0.25 to 1%. So the trailer fees, that again, the investment advisor gets that percentage because they monitor. So see, if somebody buys a mutual fund from you, as a mutual fund rep, you're expected to review it on an annual basis. It's not just a one-time effort. You are going to be doing work on it every year, looking at it, reviewing it every 3 months, 6 months, 1 year. So there's a trailer fee also that you will get for monitoring the fund and having again meetings with the client, right? Even though they don't buy anything else, um, you still are providing them service. So the trailer fees covers that. The sales fee or the load charges, those that are paid upon purchasing these are like we just mentioned, they're the front end load, right? So there's front end load and there's back end ones also. On redemption, when you pay it, it's called back end fee or deferred sales charge. And I showed you there in the fund facts, mutual funds that do not charge the fees, they're known as no load funds. Okay, so the bank ones, mainly they are no load, meaning they do not charge you any fees, right? So those are the no load funds. The acquisition fee is also, so this is based on a dollar figure, usually based on your investments. So yeah, so here now we talk a little more about the redemption fee. So we already talked about the front end fee. Now we talk about the redemption fee. So these fees are paid when the investor sells the funds, sells the unit. When you sell, you have to pay a fee. An example here they're giving you, if you start out with $15 and you end with $20 and the back end fee is 3%. So 20 minus 15 times 0.03%. So if you calculate that, your client is going to get less money, right? So they're going to get 15 times 0.03. So they're going to be 45 cents is going to be minused from it, from the $20, right? And that means that they're going to be getting 19.55. So we'll again do those calculations later, but redemption fee basically is a fee that is charged when you sell your mutual fund. Okay. And then other fees, if you have an RSP or a RIF, so these are registered accounts, as you remember, if you have a registered account, the company has to send your information to the government, and there's different fees for setting it up. So they may charge you like $25, $50 fee to set it up. If you close your account, they may charge you a fee, $50 to close the account. So that is like also possible. So when you close it, sometimes they waive it. If a person dies, then usually they will not charge it. But if you transfer your money out from one bank to another, they may charge you an account closing fee. Then transfer fees, if you switch your investments from one investment to another, they may charge you a transfer fee. And so these are also possible. So this is like, these are things that we talked about that you may be charged because of your fees there. So now we talk a little more about the MER. So the management expense, we said those fees I just mentioned, those are sometimes most of the companies they charge those fees, but MER is always charged. You will get all the mutual funds, they will charge you MER. Is the total of the management fees and operating costs paid by the fund, and it is expressed as a percentage of its average net assets. So it is, and it comprises of three main things. So it has operating expenses and management fees, and also some sales charge. So the management fees, they are going to compensate the investment firm, which is known as the fund sponsor. So obviously the fund manager is going to get the management fees. Turnover rate, if the company mutual fund is selling a lot of the funds and the stocks, and they have a lot of turnover, then like if they're selling a lot of the stocks and buying a lot of stocks, so then there will be more turnover. More turnover means that they have a lot of more risk also. So the like the value funds, remember the value funds are those which are invested in one type of stock which is low in value right now, low price, but they're expected to go up. So they will not sell them frequently. Their turnover rate is going to be low. But if it's a growth fund, they may have 100% or more turnover. So the more turnover ones rates have a greater risk. And there's a lot of other tax issues. They're buying and selling. There's capital gain, capital loss, and other stuff also. Clear? Trading expense ratio, TER. This should also be shown in the fun facts document. In Scotiabank, I don't know why they don't show it, but in RBC ones they do show the trading expense ratio um, in the fun facts. It should be in the fun facts. The trading expense ratio is for mainly for the stocks and bonds, right? So they are also there, and they are mainly also. So that's another. It is included in the MER actually. Okay, so the MER includes that cost also. Okay, accumulation plans, systematic withdrawal plans. I think I'll show you that in the book. Okay, we have 5 minutes more. I think we're not going to finish this chapter today. I want to, I think, so tomorrow's off, day after tomorrow. I'm going to start here again. I want to show you this in the book, but I want you to read ahead. I think today, so we have covered, let me stop the recording. Yeah, so stop